In the world of global finance, one currency stands above all others: the US dollar. It is the world's undisputed heavyweight. But in the heart of Asia, there is another currency that moves in near-perfect lockstep with it. It isn't issued in Washington, yet it moves closely in step with the US dollar. Traders call it Asia's US dollar. This is the story of the Hong Kong dollar, a currency that sacrificed its independence to become the most stable bridge in the world. To understand why this currency exists, we have to go back to 1983, a year when Hong Kong's future felt like a coin toss. Negotiations between Britain and China over the 1997 handover had hit a diplomatic stalemate, and the resulting uncertainty was poisonous. Confidence didn't just leak, it evaporated. On September 24, 1983, a day forever etched in history as Black Saturday, the markets delivered a brutal verdict: Hong Kong was finished. In the crowded stalls of Kowloon, the price of rice doubled in a single afternoon. Panicked citizens hoarded canned goods and toilet paper as the Hong Kong dollar went into a historic freefall against the greenback. The government faced a binary choice: watch the economy vanish or perform a radical organ transplant. While the streets were in chaos, a solution was quietly being forged in the mind of John Greenwood, then chief economist at GT Management. Greenwood had been obsessed with the flaws of Hong Kong's free-floating currency long before the panic hit. As the crisis deepened, his research became the city's only map out of the storm. Even the legendary Milton Friedman took notice. In his autobiography, Two Lucky People, Friedman recalled the intensity of those days, noting that he and Greenwood would discuss the granular details of the reform proposals over the telephone almost every single evening. Greenwood's blueprints, originally published in the Asian Monetary Monitor, eventually landed on the desks of the men tasked with stopping the bleeding, officials like Douglas Bly of the Financial Services Branch. They recognized that Greenwood wasn't just offering a theory, he was offering a lifeline. On October 17, 1983, they threw an anchor into the storm. They officially fixed the Hong Kong dollar to the US dollar at a rate of 7.80. It wasn't just a policy, it was a survival pact that remains unbroken to this day, earning John Greenwood his place in history as the father of the linked exchange rate. Most countries have a central bank that prints money based on economic goals. Hong Kong is different. It uses a currency board. Every single Hong Kong dollar in circulation is backed by a US dollar held in reserve. The Hong Kong Monetary Authority, HKMA, acts as a giant vending machine. If you want Hong Kong dollar, you give them US dollar. If you want US dollar back, they have it waiting for you. This creates a convertibility zone between 7.75 and 7.85. If the Hong Kong dollar gets too strong, the HKMA sells Hong Kong dollar and buys US dollar. If it gets too weak, they do the opposite. It is a system of total discipline. No printing, no cheating, just pure backing. There is a price for this stability. Hong Kong has no control over its own interest rates. If the Federal Reserve in Washington raises rates to fight inflation, Hong Kong must follow, even if the Hong Kong economy is in a recession. Why? Because if US rates are 5% and Hong Kong's are 2%, everyone would sell their Hong Kong dollar to buy US dollar for the higher return. To keep the peg, Hong Kong effectively imports the Fed's brain. When the U.S. sneezes, Hong Kong doesn't just catch a cold, it takes the same medicine. For over a decade, the peg worked perfectly. But in 1997, Asia's dollar faced its ultimate test. Remember our old friend, the Asian financial crisis? We mentioned it in our last currency-related video. In case you would like a memory refresh, I put the link in the description. A financial plague was sweeping through the region. It began in Thailand, where the baht collapsed after speculators realized the government didn't have the reserves to back it. Like a falling row of dominoes, the Malaysian ringgit and the Indonesian rupiah followed. Currencies that had been stable for years were wiped out in weeks. The market sharks smelled blood in the water. Led by legendary figures like George Soros, global speculators turned their sights on the biggest prize of all, Hong Kong. They believed the peg was a lie. They bet billions that when the pressure got high enough, the Hong Kong government would break, just as Thailand had. But inside the 30th floor of 3 Garden Road, the old headquarters of the Hong Kong Monetary Authority, 2 men were preparing for battle. Joseph Yam, the first chief executive of the HKMA, and Donald Tsang, the financial secretary. In August 1998, this office became the epicenter of a financial war. The speculators had launched what is known as a double play attack. They weren't just trading, they were trying to break a city's spirit to turn a profit. To understand the attack, you have to understand short selling. In a normal trade, you buy low and sell high. In a short sale, you do the opposite. You borrow something you don't own, say 1 million shares of a bank, sell them immediately at a high price, wait for the crash, buy them back cheaper, and pocket the difference. The speculators' double play was a masterclass in manipulation. First, they heavily shorted the Hong Kong stock market, betting it would crash. Second, they attacked the currency, selling billions of Hong Kong dollars. They knew that when they dumped HKD, the city's aggregate balance, the cash banks keep at the central bank, would shrink. Under the automatic adjustment mechanism, this causes the cost of borrowing, the HIBOR, to skyrocket. In 1998, interest rates hit a staggering 300% overnight. The speculators believed they had a win-win. If the government raised rates to save the currency, the stock market would crash under the weight of those rates, making them billions on their stock shorts. If the government didn't raise rates, the peg would break, and they'd make billions on their currency shorts. It was a death trap. But the HKMA did the unthinkable. Breaking the holy grail rules of free market economics, they used their massive exchange fund, which, by July 1998, had reached nearly $96.5 billion, making it the 3rd largest reserve fund in the world at the time, to fight a war on 2 fronts. On the first front, they bought HKD to stabilize the currency. On the second front, they stepped directly into the stock market. In just 2 weeks, they spent $15 billion buying up blue-chip stocks, effectively becoming the market's buyer of last resort. The speculators blinked. They simply could not outspend the strength of Hong Kong's reserves. The HKMA forced the speculators into a short squeeze of biblical proportions, making it too expensive for them to maintain their positions. The result? The speculators retreated with massive losses. While the rest of Asia saw their currencies devalued by 50% or more, the Hong Kong dollar didn't move an inch and survived its baptism by fire. By refusing to blink, the Hong Kong government didn't just protect a currency, they protected the world's trust. They proved that the peg wasn't just a policy, it was a fortress. In the wreckage of the 1997 crisis, while neighboring economies spent years rebuilding from zero, Hong Kong emerged with its credibility reinforced in steel. It was this victory that truly solidified its nickname. No longer was it just a local currency, it had become Asia's U.S. dollar, a global proxy for stability in an unpredictable region. The world now understood. To bet against the Hong Kong dollar was to bet against one of the most disciplined financial machines ever built. This trust became the bedrock upon which the city grew into the world's premier gateway to China, a status it still defends today. Why does China allow this mini US dollar to exist on its doorstep? Because the HKD is China's financial lung. The Chinese yuan is not fully convertible. You can't just move billions in and out of Shanghai. But in Hong Kong, there are no capital controls. Global investors can use the stable, dollar-linked HKD to invest in Chinese companies listed on the Hong Kong Exchange. It is the safe harbor where the rules of Western finance meet the opportunities of the East. Can the peg last forever? Today, the challenges are political as much as financial. As US-China relations chill, some wonder if the fixed link could become a liability. If the US ever restricted Hong Kong's access to the US dollar clearing system, the peg would face an existential threat. Furthermore, as the Chinese economy grows, the pressure to link the HKD to the yuan instead of the dollar grows with it. But for now, the HKMA is clear. The peg is the bedrock of the city. Abandoning it would be like removing the foundation of a skyscraper while people are still working inside. Traders call the Hong Kong dollar Asia's US dollar because it offers something rare in an era of volatility: predictability. It is a currency that chose discipline over independence. It doesn't try to be a global reserve currency, it tries to be a global bridge. And as long as that bridge holds, American monetary influence will continue to flow through the veins of Asia, one fixed exchange at a time. In a world of floating values, the Hong Kong dollar is a reminder that sometimes the greatest power isn't in moving forward, it's in standing perfectly still. Don't forget to like and subscribe to keep your financial shield strong. Thanks for watching.